So welcome, my friends. If you remember last time we started module number 13, which is sources of finance, right? So we have almost covered more than half of this chapter. So we talked about the need for finance, why finance is needed for organization. Definitely, we need to run operations, right? We need to do investments. We need to pay to the employees, right? We need to pay suppliers. We need to pay for inventory, utility bill, so many things. Anyways, so we discussed in detail short-term finance, long-term finance, right? Equity debt, you remember? Then we discussed about ordinary shares. They are the real owners of the business, remember? Also called common shares, common shareholders. Then we discussed the procedures involved in issuing new shares, right? Then stock market concerns, right? Why we need to go to stock market? Because it is a wider pool of finance. We can get more money as compared to if we have private company, right? Then we discussed about underwriting also. Remember what is underwriting? When you issue shares, if some shares are not taken up by the public, so there will be that broker or commercial bank or investment bank, whoever is there, they will buy the remaining shares, right? Then we discussed about how to obtain a listing. So we also discussed about something called alternative investment market when you are a small company. So you can go on this exchange in the UK, right? So why they are giving example of UK? Because this course is little bit UK focused, right? That's why. Then we discussed about common method of issuing shares. Remember, offer for sale or offer for subscription, placing, and intermediary offer. Then one by one, we discussed in detail about offer for sale and offer for subscription, right? What is offer for sale? You invite the public by existing shareholders to purchase the shares already which are in issue, right? What is offer for subscription? New brand shares, new brand. Okay. So then we discussed about uh, uh, so moving on, my friends, we discussed about underwriting, right? What is underwriting? To make sure that all the shares are sold. Remember, I hope you people have highlighted also, underline, highlight, whatever you have done. And then remember, you need to set issue price also. How to set issue price? Who will help you out? Remember? Offer for sale by tender. This one, like I told you, remember auction. Whoever give you the highest, they get the shares, right? Placing, we discussed intermediary offer and rights issue. Remember right issue? You have owners, existing owners. It is their right that they should be offered the shares first, right? Then share option scheme you give to your senior employees, right, directors. You tell them, okay, after the many years, you have the option to buy the share at this price. So they work towards it, right? And then I also discuss with you, they can do manipulation. And I gave you some examples also. In the past, big companies, they went bankrupt because of manipulation. Then scrip, dividend, scrip issue, stock split. Remember, scrip, I told you we give free dividend. Okay, and there are some reasons. Maybe I don't have cash flow, or maybe my price is too much in the market that people are not trading my share. So what to do? I give them free share. So the supply increases, the price will come down, right? Then stock split, you just split the stock. Like one share, now it is two shares. That's it. And par value also reduced. No effect, no entry, no double entry in stock split. Remember? If examiner is asking you, what is the double entry of stock split? Answer is nothing. No double entry. Okay. Then, my friends, we talked about repurchase of shares. I told you the company has the right, but not the obligation to buy back the shares. Which shares? Common shares. Irredeemable preference shares. Because when we issue common shares, they are in existence indefinitely. When we issue irredeemable preference shares, they are also in existence indefinitely. The company will not buy back. If as a shareholder you are not satisfied with the company, what to do? Sell in the market. But if you talk about bond, you talk about loan note, debenture, redeemable, redeemable preference shares. All this the company has to buy back because these are debts, loans. However, the company can also buy back equity. As I said, the company has the right, not the obligation. Okay, so it means they anytime if they want, they can go to the shareholders and they can ask the shareholders, please sell the share. Now you will ask me, sir, why the shareholder will sell? Because the company will give them a good price. The company will give them a good price. That I want my shares back. In the market, the price is 100. I am giving you 120. Give me my share. So you want to reduce the equity due to some reasons which we discussed. Then I told you it is called treasury shares, or you can call it capital redemption reserve. Okay, this will stay in your balance sheet as a minus. Later on, you can reissue these shares, right? Okay, or you can cancel. Preference shares, remember, these are not the real owners of the business. They don't have voting rights. They have fixed dividend. Remember why they are called preference shares? Because they get the dividend before common shares. That's why this is the preference. And when the company will liquidate, they will get their money before the common shares if something is remaining. Right or not? So, my friends, then we discuss loan stock bonds, right? Bank finance. Then why we need finance? For operating requirement, for capital expenditure, committed funds, overdraft facility, term loans, leasing. We completed till here. Any question? All clear? So let's continue, my friends. What we have here, invoice discounting and debt factoring. So what is factoring? Basically very simple. I mean, you have a receivable. You need to collect money from your customer. Customer is supposed to pay you after 30 days, 60 days, 90 days. But you need the money right now. So you will go to a company which is called factoring company who do this type of business. You will say, I need money. This is my receivable. I want to sell you. I need to recover $1 million from this person on this date. But I need money right now. So they will do some research. They will see your documents. They will see your image in the market, right? So they will say, okay, but tell us two things. Number one, what if the customer will not pay? What we will give you the money right now. What if after 30 days the customer will not pay? Who will bear the risk? So you said, I will bear the risk. If the customer will not pay, I will pay you back. Okay. So he said, very nice. So how much is the value? $1 million, right? They will give you $900,000. How much? It means 100,000 less. This is their commission, their profit. Second scenario. He asked you, if the customer will not pay, who will bear the risk? You said you have to bear the risk. I will not bear the risk. I am not responsible if the customer will not pay. So he will say, okay, in that case, I will give you $650,000. How much? So how much profit he is keeping in his pocket? $350,000. See, because of the risk. Because of the risk. If the customer will not pay, he will lose. You got the story? So these are the two types of factoring situations. You need to see who has the risk. Okay. So as we did in the last class, I'm giving you like 2 minutes. Please go through it quickly, this area. And let's see if we have another important point here. Okay, see, same things written here. Now, if you see here in point number B, they are giving you a word which I have highlighted also. It is without recourse. What is it? Examiner can ask you. If it is without recourse, who has the risk? So if it is without recourse, who has the risk? Factor. Right? If the customer will not pay, who will bear the risk? Factor. Okay. Another situation is called with recourse, which is not written here. You can write it. Remember, I gave you two examples. In first example, he was giving me 900,000 because I told him I will bear the risk. That is called with recourse. The risk is not transferred. What they are telling you in point number B is my second example, in which I told you he will give how much? 650,000 only. So he's charging too much profit because I am transferring the risk. More risk, more return. So examiner can give you MCQ and they can ask you, if it is without recourse, who has the risk? So the answer is factor has the risk. Okay. And if it is with recourse, who has the risk? Client. We call it client. Who is the client? The company which is selling the debtor or receivable from whom the money has to be recovered. You got the story, everyone? Okay, see, in factoring situation, as they mentioned, the customer will know that the factor is involved. Did you read it? They told you, right? My customer will know that I am engaging another party to collect the money. He will know, my customer will know. Okay. However, if you see below this sentence, because this is a difference, there is something called invoice discounting. See on the top, the heading, invoice discounting and debt factoring. There are two concepts. There is a difference, slight difference. Debt factoring I just discussed with you. Now, what is invoice discounting? It is like factoring. Okay. However, the invoice discounter does not take over the administration of my collection. And the client is responsible for collecting the debt. Client is responsible. Okay. So I mean, again, here what happens is I go to this person, I say these are 10 invoices, I need money. Okay, so he will give you the money, he will take some commission. Hmm? But he will not collect the money on your behalf. You have to collect the money and give him his profit. You got the story? See again, the customer whose debt has been sold is unaware. Please highlight this. Unaware. It means in the invoice discounting, my customer doesn't know that I have sold him. In factoring, my customer knows that I have sold him. Why? Because the factor will call now. Hello, I am factor. Your client appointed me to collect money on his behalf. Huh? But in invoice discounting, this will not happen. Clear? So like they are saying, it enable you to raise some working capital. Okay, mostly you need to remember, normally invoice discounting is done for short term and small money. Factoring is done for big money. Invoice discounting is done for small invoices normally. Okay, and factoring is done for big fish, right? In millions normally, big amounts. Okay, then this is like they are giving you the same example I gave you already, so you can read it later on. So this was invoice discounting and factor. Clear? Main points you need to remember, which I told you. That's more than enough for exam perspective. Then they are telling you, my friends, capital structure and sources of finance. Right? We already discussed. I don't know why they are giving it again. What is our capital structure? Two elements: debt and equity. Right? What are the two main sources of finance? Again, debt and equity. Right? So this is what they are talking about. Okay. What they are saying here is we need to have a balance. That how much we need to keep equity and how much we need to keep debt. Because both of them have different advantages and disadvantages. Similarly, we need to keep a balance between short-term and long-term finance. All examples we already discussed above. What are the short-term finances? Different example like bank overdraft. What are long-term finances? Term loan, bond, like that. Okay. So, okay, quickly read through these three paragraphs and tell me whatever I explained you before, it is written here or not. Okay, remember we did interpretation of financial statements, module number 3 or 4? 4. So remember we discussed this ratio, debt to equity ratio. This is what they are referring to here. See, debt to equity ratio. That how much is your debt as compared to your equity. Okay, tell me, which is better, debt or equity? Debt. Huh? Yeah. What is better, debt or equity? Why? Because interest exempted from the tax for interest is exempted. Taxable. Okay. Huh? Tax deductible. Tax deductible. Very nice. And because this cost of debt lower than cost of. Very nice. Cost of debt is also lower than cost of equity. But equity requires rate of return higher than debt and riskier. Okay. Again, I am starting up a company. What is better, debt or equity? Usually the equities. It's different. I am starting a company. From where I will get finance? We discussed in the last class. Huh? Equity. Equity will start up the business. Right or not? Later on, you will go to debt. So you are like after 2-3 years now, you want finance. Now tell me what you will take, debt or equity? Debt. Debt, huh? Yeah. There is no one answer, my friends.
Except it's dependent in this situation.
Yeah. There is no one answer. We know their advantages and disadvantages, but we need to see the scenario of the company.
Yeah.
Before recommending them that you should take debt or equity. What is your requirement? What is your risk appetite? Means how much risk you are willing to take. What are their sales? What are their cash flows? Can they absorb the regular interest payment? I mean, can they pay a fixed commitment or not? Are they in a position or not? Because we know debt is a cheap source of finance, but there is a fixed commitment. In case the sales will go down, you will go bankrupt.
Yeah.
So that's why. And similarly, you need to see your ratio also. You need to see what your equity holders want. You need to satisfy them also. Right or not? You need to see how many liabilities already you have. Are you in a position to add on more liabilities? So many questions. However, overall, if we say the equity is expensive, to issue equity also expensive, debt is cheaper. Interest rate is low, tax is, interest is tax deductible expense also. And also they are not my owners. They are not my owners. If I issue equity, I increase owners in my business. More owners, more headache. Right or not? But at the same time, if I take loan from the bank, it doesn't mean that the bank will not dictate me. That is also a headache. Because bank will put restrictions on you. Covenants, we call it covenants. Right or not? Bank might take a security from you. Bank will say you cannot sell this property, you cannot sell this land before repaying my loan. Right or not? Your ratio should be this much. Your current ratio should be this much. Your quick ratio should be this much. Like that, they will give you requirements to fulfill. Right or not? So these are the things, my friends, you need to remember. Okay, so all that is written here as well. Quickly go through this also. Quickly, please. These paragraphs. So they are saying you in the second paragraph, if you want to buy a long-term asset, like you are buying a plant, not that plant, huh? Plant means plant, factory plant, huh? Not that flower plant. Okay. So that the life of the plant is 15 years. So you can take a 15-year loan to buy that plant. This is called maturity matching approach. Maturity like 15 years. So my asset on the one side is 15 years, my liability on the other side also 15 years. So matching, good for me. You got my point. So you need to finance related assets with related debt. It will be easy for you. Clear? Because when you will use the plant, you will generate money to repay the loan. Right or not? I mean, let's assume if you buy a plant, 15-year life plant with 3-year loan, can you pay the loan in 3 years? From where you will pay? Can you pay? No, you don't have money to repay the loan. It's a huge loan. So you should take the loan over the same life of the asset. So you use asset, earn money out of it. Some keep in your pocket, some keep in the bank pocket. So loan is repaid and you are earning for 15 years. You got the point? Like, these limousine drivers, what they do, same thing. They take car on lease, 4-year lease. Then they drive Uber limousine. So they earn, for example, 3,000-4,000. They pay to the company maybe 1,500, 2,000. Remaining they keep in their pocket. So after 4 years, the car is with them. Loan is repaid. Now full money for them. And even if they want, they can sell the car and get good cash also, buy new car. Like that. You got the story. Online people, if everything is okay, please write yes in the chat box. Okay, same thing they are telling you here also. Long-term requirements. Debt and financing risk. This already I explained, you remember? If a company build up debt, it cannot pay. It will be forced into liquidation. I think we know this already. Right or not? If you take loan which you cannot pay, what will happen to you? You will liquidate, bankrupt. So, gearing, I don't want to repeat it. We did already in module number 4. Remember? What is gearing? The ratio of debt to equity. Right? So you can read through it. It's very simple. Just a recap of module number 4. So then they are talking. How many pages remaining? 1, 2, 4, 3, 4, 4, 5. 5 pages remaining. We are almost there. Huh? So, my friends, short-term financing and capital structure. Okay, remember we discussed these examples. Can you remind me what is a bank overdraft? All of this already we discussed in the chapter, last class. Yes. What is bank overdraft?
Bank will provide the credit facility.
You have 10,000 in the bank account, but you can go in minus. You need to do arrangement with the bank. So if 10,000 finished,
We can give you 2,000.
and you issue a check to supplier for 2,000, for example, the bank will honor the check. The bank will honor the check, means the bank will give to the supplier 2,000, although there is nothing in your account. So you will go in minus 2,000. This is called bank overdraft. So based on size of the company, your relationship, your image, your history with the bank, they will give you limit. Like your credit card. Depends on your company, reputation, your salary, they give you limit. Same like that. Okay, you have to pay interest for the number of days you are in minus. As soon as you come in plus, interest stops. Right? Then trade payable, remember I told you, trade payable is a free loan. You buy something from supplier and you say I will pay after 30 days, 60 days, whatever, but you don't pay interest. So it is interest free loan, short term loan. And this we just discussed, remember? Invoice discounting, factor financing, bill financing, acquiring equipment under operating lease agreements. We discussed last time leases. So they are telling you this diagram, they are saying 3 alternative policies we have, A, B, and C. The dotted line A, B, and C are the cutoff level between short-term and long-term financing. So this is for each of the policy A, B, and C. So these are different policies A, B, C. This is time. And this is asset value. Okay. So if you see, they are saying this dotted line, this one, this dotted line. Assets above the relevant dotted line are financed by short-term funding, while assets below the dotted line are financed by long-term funding. So assets value. So see, this is your asset base. What is this? Zero. I mean, when you start up your business, you start from zero. So when you start your business, which asset you take? Non-current or current?
Non-current.
Huh? When you start your business, like they need to set up this floor when they start up this office. So which asset they took that time? The marker or the table and chair? Table and chair. TV. These are non-current assets. Later on, they will buy current assets. Like books. When the classes will begin, books for them are what? Current assets. Because non-current asset we buy to use. Current asset we buy to sell. You got the story. So when we start the business, we need first non-current assets and we need long-term funding. So that's what they are saying below the dotted line. Permanent. See, first non-current assets, then permanent current assets, then fluctuating current assets. Right? Getting the story. So when you go above, you need short-term funding because this is fluctuating. See this line, this line. So fluctuating. Requirement is fluctuating, so short-term finance. But the non-current asset requirement is not fluctuating. We knew that we had 10 rooms and we need 10 televisions and all these things. Like that. So we know that. Okay, in short, again the same thing they are telling you that if you want to buy non-current assets with long-term funding. Short-term assets, short-term funding. Clear? So they are saying funding the investment in current assets, the volume of current assets. Okay. If you remember, we did a chapter called working capital management, module number 12. Right? So we discussed about receivable. We discussed how much receivable we should have. We discussed about cash. How much cash we should keep in hand or at bank. We discussed about inventory. We discussed how much inventory we should hold. Factors to consider. Remember, not too much, not too low. Right or not? Same they are telling you that how much current assets you should keep. What is current asset? Receivable, inventory, and cash. Huh? So, and that's why we calculate something called current ratio. Remember, current asset divided by current liability. So, can anyone tell me how much should be the current ratio? Best practice.
1.2.
1 point, more than 1. More than 1. Right or not? But if my current ratio is 2, 3, what you will say? No. Then I will say you are stuck because you have too much money stuck in the inventory, too much money stuck in the receivable. Right or not? This is not good.
This ratio should be between 1 and 2. This ratio. For current account.
Right or not? Your current ratio should be above 1 at least. Best practice. But too much current ratio is not good for the business. It means you have too much money stuck in the inventory, you are not able to sell it. You have too much money stuck in receivable, you are not able to collect the money. Or cash is idle, you are not investing. Like that. So this is what is written here, my friends. And they say, see, whatever I was telling you, they are also coming towards it also. Like excessive quantity of inventory, allow debtor to pay excessive time, right? So this all lead to your excessive working capital, or you can say over capitalized. Okay, when you have too much current ratio, it means you are over capitalized. This is the terminology to be used. How to solve the problem, my friends? By doing module number 12. What is module number 12? Working capital management. Management. So we did different exercises. If you remember, I gave you assignments also. So we discussed how to improve working capital management. Remember different ways of, remember follow up, call your customer, send reminder, send email. There are full steps we discussed like that. So If you have excessive inventory, receivable or cash or whatever, there will be an over investment. Yes. See, over investment by the company in current assets, which is basically current ratio more than 2, more than 3, like that, which is not good. Okay, read this last paragraph, very simple. They are saying overcapitalization can be avoided if there is good management. As simple as that, right? And then they are telling you here some ratios also, like we keep discussing about current or quick ratio. They can indicate you that you have over invested, right, in the current assets. Similarly, sales divided by working capital, if you do, you can also get a idea. For example, let's say your sales are 100. Working capital is 50. Huh? So how much is the ratio? 2. It means what? That on $1 of working capital, you are generating $2 sale. Right or not? If your sales are 200, your working capital is 100. It means again 2. Right or not? By using $1 of working capital, you are generating $2 of sale. Right? So they are saying you that the total volume of working in comparison to previous year. Yeah, you need to see, we cannot say 2 is better or not. Like we discussed in interpretation also. In isolation, you cannot comment. You need to see previous year. You need to see your competitor. You need to see industry average. Then only you can conclude. Right or not? That whether I am operating well or not. Okay, remember turnover, receivable turnover, payable turnover, inventory turnover. Remember, what was that? That how many days you are taking to sell your inventory, how many days you are taking to recover money from the customer. Like that we calculated, remember? So those can also give you an idea about over capitalization. If you have too much days in inventory, it means you are over capitalized. Too much days in receivable, over capitalized. Right or not? Online people, please write yes in the chat box if you are getting the points. Okay, then we have something called over trading. And I think this is the last topic. Yeah, finished. Right? So over trading will finish this topic. What is over trading? Very good concept.
High level of sales.
Very, very nice concept. They say over trading occur when a company try to finance the inventory and receivable largely from the current liabilities and insufficient investment of long-term funds in the working capital. Very simple. It means okay. Basically, whatever we discussed above what we discussed, over capitalized. Reverse it. What is the opposite of over capitalized? Under capitalized. What is the opposite? Under cap. This is called over trading. Another name for under capitalization is what? Over trading. See this? Over trading or under capitalized. So it means your current ratio is lower. Less than 1. Huh? So your liabilities are more, your current liabilities are more, your assets are less. So what will happen, my friends? This will happen or not? See, I am highlighting in red color. What will happen? Cash flow difficulty or trading liquidity problem will happen. Like for example, very simple. You are waiting for money from the supplier so that you can pay your salaries to the employees, or you can buy inventory. Huh? You don't have inventory, so you are not able to sell. From where the money will come in? From supplier. Supplier are delaying the payment. Because of that, your business is affected. Why? Because you didn't put enough money as a cash or bank. apart from the liability, rather than relying on, not liability, my friends, customers. Who will pay you? You people are also accepting my argument. Who will give me the money?
As customer.
Customer. I am waiting from the customer, not from the
I
supplier.
said customer, but you continue.
So I am waiting from customer to give me the money,
Okay.
so I can do my payments, right? So, but very less. My payments are more, recoveries are less, cash is less, inventory less. So supplier called me, he said, where is the money? Around 100,000. I checked my bank account, 1,000. I checked my customers from whom I am to recover the money, 5,000. Inventory in the warehouse, 50,000. How much I have to pay supplier? 100,000. From where I will pay? This is called under capitalization. This is called over trading. Because even if I give him 1,000, he will not accept. Even if today my customer pay me 5,000, total 6,000, I pay him nothing. He has 100,000 balance. Okay, I will tell him, Habibi, go in my warehouse, take the inventory. Still not fulfilled. Because inventory is worth how much? 50 only. He need how much? 100. You got the story? So my friends, again, remember we discussed in the module 1, 2, 3 that profit is not cash. I told you or not?
Yes.
Profit is not cash. And we proved it also by creating the statement of cash flow. We reversed it. We started with profit, right? Same they are telling you in this paragraph. See this? Despite operating at a profit. So you are a profitable company, but because of this under capitalization, you can, still there is profit, but cash is not there. In the income statement, profit is coming, but cash flow is overdraft. Possible. Because profit is not cash. Right or not? Remember in the profit or in the sales, we put credit sale also.
Yeah.
So you are having credit sales too much, but money is not there. Right or not? So this is okay. Read the last sentence, please. Over trading is. This is the conclusion. So you are doing excessive trading without any backup plan. Okay, so you don't have a plan B. That if my customer will not pay, if I am not able to sell my inventory, how I will pay my liability? Clear? Right or not? You know, sometimes in your look into your personal life. You will find example yourself. Okay. So you are anticipating money from someone. Based on that, you did an expense. Huh? Later on, that person didn't pay you or delayed the payment. Then big problem for you or not? So you need to have a plan B. You need to have a plan B. Right or not? Getting it? Otherwise, you will definitely suffer. Right? So I remember I was doing a training. Okay. So I took a risk, but that worked for me. That worked. So what happened was that was a good training, and there was a marriage of my cousin. Okay. So till last moment, I was not sure whether I will go or not. Even I didn't think about it. Yeah, in Pakistan. That time I was in UAE. Okay. So I got this training opportunity, and I was expecting money to come from that guy. Okay. So what I did, tomorrow is the wedding, right? So today I booked the ticket. Ticket I booked from credit card. Still now I don't have money. Huh? So I booked booked the ticket. And because they were expecting me, but I was not going because definitely it's a cost. So I took the ticket last moment. So definitely it's expensive or not. And it was Etihad Airways. Etihad Airways, last time ticket. It was too much for me. But I took it. I took that risk. That this guy will pay me. So I went only for 2 days. I attended the marriage. I came back. And then I had a class with him. So he paid me. Finally. Yeah. Otherwise I would have been in trouble a little bit. But somehow things can be managed. Right or not? But
sometimes
Alhamdulillah.
you have to take a decision.
Yeah, it was a good decision. I enjoyed really 2 days. Okay. So, anyways, my friends, see this example. Okay, this example they are giving you. I think you can read through it later on also. What are the symptoms of overtrading? So you have rapid increase in sales revenue. Again, can you remind me what is overtrading? Overtrading means your assets are less, your liabilities are more. Okay. You are undercapitalized. You are undercapitalized. Okay. So how you can be undercapitalized? You have rapid increase in sales. You have rapid increase in volume of current assets and non-current assets. Because of which, what is happening? Your turnover is slowing down. Like you are not able to sell your inventory. You're not able to liquidate it. So you don't have money to pay your liabilities. Getting the story? Okay, there is only a small increase in capital through retained profits, maybe like that. Okay. If you are buying any assets, mostly you are financing them by credit, not by your own money, not by equity, not by your funds. No. You are financing them by the supplier, trade payables, or bank overdraft. How you can finance by trade payable? You can delay their payments. You can delay. Like you have to pay someone after 30 days. Okay. After 25 days, you still have intention to pay. On the 25th day, you got another offer or another opportunity. So instead of paying this guy after 5 days, you put that money somewhere else. After 5 days, what will happen? Definitely he will call you. I don't know. Then what you will say? Sorry, I don't have money. Please give me some time. More days, like this. You got the story. So that's why the best way to handle this situation is to allocate the money and don't touch it. Don't touch it. Like for example, after 30 days, you know that you have to pay someone 2000. Huh? So on the 15th day or the 20th day maximum, you should spare that money separately and don't touch it because the payment is upcoming, right? Due. Because when you see the payment, most probably you will spend here and there. So after 30 days, you will not have money to give to that guy. Right or not?
But if something, for example,
Emergency is rare situation. I am talking about spending somewhere else. Because it is his right. First is his right to be paid because he gave you the privilege, right?
Yes.
Or not? He trusted you that you will pay after 30 days. So you need to pay after 30 days. Right or not? So my friends, or bank overdraft like that. And similar, okay, these are all symptoms. When you see the interpretation of the financial statements, you can identify from there that whether this company is over trading or under trading, like that. So similarly, current ratio is falling, quick ratio. This is what we discussed. Remember, your current ratio is last year 1.2, this year 0.8. Quick ratio last year 0.8, this year 0.5. So reducing. It means your current assets are falling and your liabilities are going up. So it means you are over trading. Examiner can give you a question. Which of the following option represent over trading? So 3 option he will give you under trading and 1 option will be over trading. Getting it? Okay, again, over trading means under capitalization. Don't mix it, huh? Remember? Over trading means what? Under capitalization.
Current ratio is less than 1.
Yes. And the opposite is over capitalization, which we studied above. What is over capitalization? You have too much stuck in the assets unnecessarily, right? So that is different situation. Okay. And again, see, they are saying liquid deficit. What is liquid deficit? Excess of liability over assets. Simple. We know this. Excess, our liabilities are more, assets are less. As simple as that. Clear? Okay, so even you can write here if you want to remember this. See, make notes and highlight with me. See, what is over trading? Current assets low, right? Current liabilities high. Like this you can write, so you will not forget, right? And same thing above you can write opposite in the over capitalization. Again, remember, over capitalization is not over trading, right or not? So what is over trading? Under capitalization. Under. Okay. Because that over thing can confuse you later on. Okay, this is over capitalized. Sorry, under capitalization. Clear? Okay, go above. See, this one also I highlighted for you. Over trading is also called under capitalized, right? And above what we studied was over capitalization. This is different thing, right? Okay, can I call it under trading? By the way, they didn't mention it here, but we can call it. What we can call it? Under trading. Opposite, right? And not undertaking. Under trading. So mention it. Clear, everyone? This is under trading. Easy, difficult? Huh? Easy, difficult?
Easy.
Very easy, very easy.
Easy.
Not easy, not difficult. So my friends, you know, nothing is easy. Nothing is difficult. You make it for yourself easy or difficult. You know this? Huh? Ahmed? Nothing is easy. Nothing is. It's up to you whether you want to make it easy or difficult. How to make it easy? By revising it. By making notes. Simple. How to make it difficult? By not revising it. Waiting for 1-2 weeks more. Then after 1-2 weeks more, when you will open the book, you will realize that when we studied this topic, then you will open the video again. You will waste your 2 hours again to recap the things. So why not revise tomorrow for 15 minutes and save your time? Huh? Right or not? Right? So this is the completion of module number 13.